Hello. So I just got home from an open house here in Everett over on Upland Avenue. And it was a really, really cool house. I it was just really pretty. We were leaving, it was like the golden hour, and the sun was just starting to get over to where it was about to set, and it was beautiful. Anyways, this house was priced at $1,049,900, and it was the house that I talked about in my video yesterday, where I gave you a range, a 200,000 to 250,000 as an annual income of what you would need to make to probably qualify for that house. Now, remember, every situation is different, so ultimately, like how much you have to put down is going to affect what you qualify for. What your credit score is going to affect what you qualify for. But just, using a rough basic somewhere between 5% and 20% down. That's kind of how I came up with that range. So the first thing that is affecting that range is the difference between 5% and 20% down. So if you look here at the loan amounts, if you're only putting 5% down, your loan amount is $997,405. If you're putting 20% down, your loan amount is $832,750. Now, look down here, you can see the difference in those down payments. So, 52,495 is 5%, but if you're putting down almost $165,000 more on the 20% down loan, and it's actually 20.68% down in this scenario, and I'll explain why in just a minute. Um, so, that down payment, that loan amount is going to be quite a bit larger on the 5% down option than if you've decided to put 20% down. Now, I mean, there's a lot to consider with that, right? Like, what interest rate are you paying on this loan? And what could that money be making for you somewhere else? That might be a reason to put a smaller amount down. But then you also want to consider that you're going to be paying MI with any sort of loan that's less than 20% down. So now I want to get into why this number here, 20.68. Why isn't it just 20%? Well, it is 20.68 because I am using this magic number right here of 832,750. So 832,750,000 is the jumbo threshold or the high balance threshold for 2026. So that means anything 832,750 and below are just your regular old vanilla loan, but anything above 832,750 is considered high balance. And anything over, I want to say it's 1.2 million right now, is going to be considered jumbo, meaning that it's not financeable through Fannie Mae or Freddie Mac. Still financeable, just you have less options with those. Um, You'll notice that the interest rate on these is priced a little higher. Fannie and Freddie price those interest rates just a bit higher. So we're looking at 7% on the 997,405, and we're looking at 6.625% on the 832,750. It's three-eighths of a point. It's nothing to sneeze at in any situation, but especially when we're talking about loan amounts that are this large, it's going to make an impact on your payment. And you can see that right here. You can see that the payment on the 6.625% interest rate with the lower loan amount is $5,332, and the principal and interest payment with the higher loan amount and the higher interest rate is $6,635. So over $1,000 difference in those payments, but again, you're bringing over $165,000 more to close with this option over here. So this is really why there's the difference, why that range is there. It's because the payment on the higher loan amount, the 5% down option, is so much higher than the payment if you were putting just a little bit over 20% down. And this is also where strategy comes in, right? Like if you were just to walk in the door and say, I'm gonna put 20% down, you know, great. But if you put down just a little tiny bit more, you're gonna save yourself on the interest rate. You're putting down what, not even $10,000 more, and you're gonna get 3/8 of a point lower in interest. So, this is where strategy comes in. And this side by side comparison, which I really, really love, is something that when you move forward and when you're getting your loan and you're looking at properties and we're really trying to strategize, that will put together for you. So sometimes it'll be two scenarios like this. Sometimes you'll have three that you're thinking about. Maybe you're also considering FHA option or a VA option, and you just really want to see where the benefit lies and what's going to be most beneficial for you. And also in this situation, I would, recommend running it by your financial advisor. Like I said, where is your money going to be most useful? So, all right. Well, I am going to log off because I just heard the kitchen timer, which means the pizza is done. But I hope this was helpful. And if you have any questions or if you want to go over a situation like this for yourself, please give me a call. I'd love to help you out. All right. Okay, I am popping back in here. My kitchen timer went off. The pizza's done, but now the pizza is out of the oven. The oven is off, so I can continue on because there was a couple more things that I wanted to touch on that I didn't get to. Okay, so first, I wanted to talk to you about cash to close down here. So you see your down payment, right? The 5% and the 20.68% there. But we also have estimated cash to close on this comparison. Now, this number you'll notice is a little bit higher than the down payment, and that is because it is also including an estimate for closing costs, closing fees that you would have to pay at close. Now, this is just giving you that lump sum number for this side to side comparison, but I can also provide you when we get to that point an itemized breakdown of what you can expect the fees to be, just so you have an idea going in what those fees might be. But this is still a really useful number to know what kind of is expected from you when you close. Now, the other thing to remember about these two numbers, though, is that what they don't include is they don't include your earnest money. So, when you put an offer in on the home and you put your earnest money towards the, um, to show your commitment to purchase that home, that is part of your down payment. So at the end, it's subtracted out of your cash to close. You're not double charged there. And then it also doesn't include any seller concessions. So at least not in this iteration, because at this point, we don't know if you're able to negotiate seller concessions. So if you are able to negotiate seller concessions, those would also be subtracted off of your estimated cash to close. Kind of the cool thing about seller concessions on these higher on these higher purchase prices is that when you are purchasing a $500,000 house and you put 5% down, the maximum you can get in seller concessions is going to be 3% of the purchase price. So if you're purchasing that $500,000 home, you're looking at getting about 15,000 for um, for for closing costs from your or in seller concessions. Now, this is on conventional financing. So the government loans are different and they do allow a little bit more. But for conventional financing, if you're only putting 5% down, you're capped at 3% of the purchase price. If you're putting 10% down, then it's a little higher and you can also, again, there get a little more. But when you're looking at a loan or a purchase price of $1 million, now you're looking at getting 30,000 in seller concessions, that 3%. So, it gets you a little more, and that's going to more than cover what your closing costs are and potentially leave you with a little bit left over for a rate buy down. So, again, it's all about strategy and it's about, working with a lender and an agent that are good at communicating with each other and with you so that you have a plan going in.